Hi there, wealth builders. Billy Bob here, live with the one and only Sarah, our lead market analyst. Sarah, the chat is already blowing up. Everyone's asking about Intel. The stock's up over 270% year to date, just crushed earnings, and broke out to all-time highs. The big question on everyone's mind, is Intel still a buy, or did we miss the boat? Sarah, take us through it.
Thanks, Billy Bob. Great question, and we're going to answer it methodically today. Not with hype, but with the same six-part framework we use for all our deep dives. We've analyzed Intel's latest Q1 2026 10Q filing, earnings call, and strategic updates. If you're new here, we break down business phase, business model, moat, growth drivers, key metrics, and valuation. Stick with us, and you'll have a clear, actionable view on Intel by the end of this stream.
Love it. Let's get into it. First up, where is Intel even at as a business? Are they a turnaround story, a growth stock? What?
Perfect segue. Our first protocol, business phase analysis. We use a strict decision tree. Key question, is Intel generating consistent operating profits right now? The answer, per their Q1 filing, is no. GAAP operating income was negative $3.1 billion. But, and this is critical, revenue is growing, up 7% year over year. That combination, negative operating income but positive revenue growth, places Intel squarely in phase 2, growth/transition.
So they're in the investing heavily for the future bucket. Not yet profitable on a GAAP basis, but growing. That makes sense given all the fab investments they're making.
Exactly. And that leads to our second analysis, the business model. Intel isn't just the CPU company of the 90s anymore. Their model now has three core pillars. 1, client computing, your core ultra chips in PCs. 2, data center and AI, Xeon processors for servers, which grew 22% last quarter. And 3, the big new bet, Intel Foundry Services, making chips for other companies like that announced partnership with Tesla for their AI chip complex.
So they're trying to be both a designer and a manufacturer for others. That's a huge shift.
It is. And it changes the capital dynamics dramatically. Their capital intensity is extremely high, $3.6 billion in capex just last quarter. They're not returning capital to shareholders via dividends right now. Every dollar is being plowed back into building out this foundry capacity. For viewers following a Buffett or Lynch style, this is a turnaround with optionality story, not a steady compounder yet.
Okay, so they're in transition with a capital-heavy model. But what about their competitive edge? Sarah, does Intel still have a moat?
Great question. Our moat analysis evaluates 5 sources. Let's hit the highlights. First, switching costs. Still meaningful. Enterprise customers are locked into the x86 software ecosystem. Moving to ARM isn't a flip of a switch. That's a moderate to high moat source. Second, intangible assets. Intel's patent portfolio and brand are still formidable, though their process technology lead eroded. That moat is narrowing, but could stabilize.
And the foundry bet, does that create a new moat?
Potentially through counter-positioning. If Intel can offer leading-edge manufacturing with integrated design services, that's a unique value prop versus pure-play foundries like TSMC. But, and this is key, it's emerging, not proven. So overall, we assess Intel's moat as moderate, with a direction of stabilizing. It stopped narrowing, and now execution will determine if it widens again.
Got it. So the moat isn't gone, but it's not the fortress it once was. Now, what's actually going to drive growth from here? What are the levers?
That's our growth drivers analysis. We use a 2x4 matrix. The strongest levers for Intel right now are new products, like their AI-optimized Xeon CPUs and foundry services for external clients. Increased usage. AI workloads are driving higher CPU attach rates in servers. And strategic partnerships, the Google, NVIDIA, and Tesla deals aren't just revenue. They're validation that can attract more customers. The weakest lever? Pricing power. In a competitive market with AMD and others, Intel can't just raise prices willy-nilly. So growth is real, but it's execution dependent, not margin expansion dependent.
All right, Sarah, let's get tactical. For a phase 2 company like Intel, what metrics should our viewers actually watch, not just the headline EPS beat?
This is crucial. For phase 2, we ignore trailing PE. It's meaningless with GAAP losses. Instead, we focus on 1. Revenue growth trajectory. 7% is solid, but we want to see acceleration, especially in foundry and data center. 2. Gross margin trend. This quarter, gross margin expanded 2.5 points to 39.4%. That's a green light. It shows better product mix and pricing. 3. R&D efficiency. They're spending 25% of revenue on R&D. That's high, but necessary to catch up on process nodes. We want to see that spending translate into tangible tech milestones, like the 18A node on schedule. And 4, the path to sustainable operating profitability. Management is guiding to continued margin expansion. That's the North Star.
So margins and execution on the tech roadmap are the key indicators, not just the top-line number. Now, the million-dollar question: valuation. How do we even think about Intel's stock price right now?
Valuation for a phase 2 company is about forward-looking optionality. We prioritize 2 metrics: EV/forward sales and price/gross profit. Why? Because they focus on the revenue engine and core profitability before heavy R&D and CapEx. Intel's price to gross profit is around 27 times. Is that cheap? Not inherently. But if you believe the foundry strategy works and AI CPU demand sustains, that multiple could compress as profits emerge. The key is to avoid anchoring on trailing GAAP earnings. Instead, scenario analysis. What if foundry wins accelerate? What if process nodes slip? The valuation range is wide because the outcome uncertainty is wide.
So it's not a simple cheap or expensive call. It's a what do you believe about their execution call.
Precisely. And that leads us to the actionable verdict for our viewers.
All right, Sarah, cut to the chase. Our viewers want to know, is Intel a buy here? And what should they actually do?
Let's break it down by investor profile because one size doesn't fit all. First, for the Buffett-style value investor who wants durable moats and consistent profits, Intel is still a watch list name, not a core holding. The moat is stabilizing, but profitability isn't yet consistent. Wait for clearer evidence of sustainable operating margins above 15 to 20%. Second, for the Peter Lynch-style growth at a reasonable price investor who can tolerate transition stories, Intel could be a small, speculative position. The growth drivers are real. The valuation isn't insane if you use forward gross profit, and the turnaround is showing early signs of working. But size it appropriately. This is not a bet the farm idea. Third, for our CMT viewers like some of you in the chat, Billy Bob, I know you're one, technically, the stock has broken out to all-time highs above $130 with massive volume confirmation. The trend is your friend. But as a technician, you'd want to watch for a successful retest of the breakout zone as support. A pullback to $100 to $110 that holds could be a higher probability entry for a momentum trade.
So, summary, not for the conservative income investor, potentially for the growth turnaround investor with a small position size, and for traders, watch the technical levels. What about risks? What could go wrong?
3 big risks to monitor. 1. Execution risk. If the 18A or 14A process nodes slip again, the foundry story crumbles. 2. Competitive risk. TSMC isn't standing still, and AMD is aggressive on both CPU and GPU fronts. 3. Macro risk. Semiconductors are cyclical. A recession could delay enterprise IT spending. So if you do invest, have a clear thesis and a clear exit criterion. For example, I'm buying because I believe foundry revenue will grow 30% plus annually for 2 years. If that doesn't materialize, I reevaluate.
Powerful stuff, Sarah. So the bottom line, Intel is a high conviction, high execution risk turnaround, not a passive hold. It demands active monitoring of the metrics we discussed: gross margins, foundry customer wins, and process node milestones.
Exactly. And remember, our framework is about process, not prediction. Do the analysis, know what you own, and manage your risk.
If you found this deep dive helpful, smash that like button, subscribe, and hit the bell so you don't miss our next breakdown. Drop your questions on Intel or other stocks in the comments below. Sarah and I read everyone. And as always, this is for educational purposes only, not financial advice. Do your own research or consult a qualified advisor. Sarah, thanks for breaking it down so clearly.
Thanks, Billy Bob. Keep building that wealth, everyone. Stay disciplined.
We'll see you in the next one. Build Wealth Now out. Build Wealth Now News is dedicated to research the businesses behind the stock names. Our research are done with artificial intelligence assistance using the best practices in the industry. Please note that investing carries its own risk, and you should do your own research before committing any stock to your own portfolio. This video is done for educational purpose only.